This is Brett Alvarado, and I have James Valentine here. And welcome to Make It Make Sense, the DePaul Central podcast for financial literacy and financial wellness. So, like I said, I'm Brett Alvarado. James, could you give us a little bit of background on who you are?
Yeah, sure, Brett. So I teach in the finance department and teach various courses, but one of the ones I teach is focuses on financial literacy.
Awesome. Yeah. Is that class available to all students at DePaul, or is that just available to business students?
It is, in fact, it's available to all students. In fact, here in the last week, after kind of 3 to 4 years of developing the course, running it as a special topics course, which you're required to do before you're given permanent class number, we were given a permanent class number. It's going to be Finance 205. And our expectation is that it'll be offered at least once in the 2021-22 academic school year.
Awesome. That sounds so cool.
Yeah.
We did a survey here at DePaul Central, and I think it was 70-ish% of students never have a financial literacy class in their life.
That's
So
fairly typical across all of the U.S. That it's I would contend one of the biggest problems we have in our country that could be easily fixed with very little effort is to have a financial literacy course either in high school or in college.
So, James, I have a few questions for you. Today, we're going to be talking a little bit about investing basics and, what some students can do if they don't necessarily want to really dive into investing, but they still want to know enough to prepare for their future.
Yeah.
So I guess my first question is, what is the minimum amount of money needed to invest in stocks? Is it worth it if you only have a little bit of money?
Yeah, so it's a great question. I get that all the time. And so when we think about, and by the way, I also teach equity research, which is basically a course about stocks. So I'm going to try, I guess, blend a little bit of the two of these together. The first is that as a general rule, if you're going to be investing, it means you already have savings. The idea is first you save and you have enough money saved for a rainy day or sometimes called an emergency fund. The idea is emergency fund should cover all of your ongoing costs for at least a month. And then some people would say it's even 3 months. So whatever that cost is, you need to have that in the bank and comfortable with it. The second thing is before you start investing is you should pay down any high interest loans or debt. So if you've got a credit card that's charging it, 15, 20, 25%, and you can pay that off, put $1,000 in it, or you can put $1,000 into the stock market, definitely pay off the credit card first. Now, student loans, it's kind of questionable. If you've got a student loan, I don't know what they're at right now, but let's say 7 or 8% interest rates, or you can invest in the stock market, which over time tends to grow at about 7 to 8%. It's probably kind of a push. The key thing to understand about stocks is that they are typically more volatile than other investment classes. And volatile means that you could, and I'm going to give kind of an extreme example here, but if you're, let's say, you're later on when you're out in the workforce many years and you've saved up some money and you put $100,000 into the stock market, it's conceivable that you could look at your statement a year later and that $100,000 will be worth $60,000. And you might go, whoa, how can I lose $40,000? Well, that can happen in a year. The stock market can drop 40%. It doesn't happen often, but it could even, let's just say more realistically, you could be down to 90,000. You could lose $10,000 in a year and you might go, I don't want to lose $10,000. Well, then you don't want to invest in stocks because stocks are very volatile or more volatile. There, you can buy utilities, less volatile parts of the stock market, but there's a basic concept in finance that there's a relationship between risk and return. And stocks typically are more risky, and therefore over the long term, over like 5, 10, 20, 30 years, they tend to have better returns than other things like buying a CD, putting money into a savings account, those types of things. So it's kind of a long-winded way of saying, first pay off your low cost or pay off your high cost debt. If you then make sure you have, actually first have some savings set aside for emergency savings fund, pay off all your high cost debt. And then if you are going to get in the stock market, just understand that it can be very volatile, but it also has the best returns over the long term.
Yeah. And, when you're investing, do you think that students particularly should be thinking about investing short term or long term?
So and once again, I get this question all the time in my equity research, the stock class is, you know, once again, you could lose a lot of money in the stock market very quickly. And if you can't pay your car loan or you don't have enough money to, pay for your grocery budget, then you should absolutely not be putting money into the stock market. If, on the other hand, so I've got 3 children. One is a great saver, one does not save. The one that does save, she's been able to work at Target and has saved up $4,000 or $5,000. If she wanted to take $1,000 of that and spend it on the stock market, great, that's awesome, right? There's no real downside. You have to ask yourself, if I lost all this tomorrow, would I still be okay? And that's a lot of times when you think about investing, that has to be your thought process. But if you want to kind of play the stock market, but you don't want to necessarily, you don't have the money or really shouldn't be putting money into it right now, there are all kinds of simulations out there. One of them is with Investopedia, which is another topic at some point we might have got to. Anyway, I'll just share with you that Investopedia is the single best place to go to learn about stocks. It's really well researched. They got excellent professionals that are writing the material there. And they have a little thing you can go to called Simulator, and it lets you go and simulate as though you're buying and selling stocks. And you can join these different simulations. There's thousands of them out there, and that gives you. So if you want to kind of dabble a little bit without putting money at risk, you go and do any one of these simulations.
I had no idea about the simulations. As a finance major, all of us know about Investopedia. It's kind of like the Google of finance. But I had no idea about the simulations with the stock market. That is so cool.
Yes, that's
Um,
what I do. I do it with my students in every class. In fact, we just started a new quarter here. So I got about 100 students now that I just had them all join they're called it's called a game when you start one. So we just started last week, and so there's 100 students, DePaul students in there now. And we're going to see by the end of the quarter who picked the best stocks.
that is so cool. And that's for your equity research class, right?
As well as, so I'm also teaching Introduction to Finance, Finance 310, and I'm having students do it in there as well.
Oh wow. Okay, cool. 310 was one of my favorite classes. But
That's awesome.
so okay, but to answer the question, so even if you have a little bit of money, you can definitely invest into the stock market.
Yes, just be prepared to lose it. That's all. I mean, don't put money in there you really need.
So yeah, another defining characteristic about stocks and what makes them so volatile is that you can lose 100% of what you, but your gain is unlimited.
Right, exactly. So you broke up a little bit there. I'm not sure it was your mic or my end, but yeah, you're right. You could lose up to 100%. You don't typically lose 100%, right? And this is one of the key things to understand also is that if you are going to invest some serious money into the stock market where it really hurt if you lost it, you want to diversify. It's a really key concept in investing is diversify. And when I say diversify, I don't mean go out and buy, Facebook and Google, which are both, in effect, kind of more techie type stocks in the U.S. market. I'm talking about buy something like Google and trying to think of like a good like Caterpillar and maybe Boeing and Pfizer and things that are in completely different unrelated industries. And there's a number of ways you can do that. I don't want to go too far afield here, but the idea is make sure if you are going to invest in the market, you're diversified.
Yeah. So another kind of sub question that isn't on like the 5 questions we did talk about, just for content's sake, but if you are a student that doesn't have any financial knowledge, doesn't know how to do this equity research, doesn't know how to analyze a 10K, how do you advise students investing into single like hand-picked stocks and
So
building?
in other words, how do you get into investing in an individual stock?
Mhm. Because like
Okay,
I mean
well,
like you hear all these students buying like Tesla, right? Everyone's like, oh, Tesla, but a lot of people don't know Tesla is so volatile, and I mean, these students are just like hearing like Tesla because it's cool, and then they go and buy it, right? But they don't have like the financial backing. So like, how do we protect students from them or the retail consumer?
yeah, so I think it really depends on what your objective is. If you're viewing stocks as almost like entertainment, actually, like you would bet on, let's say, a basketball game, or a bet on some other, go to a casino and bet some money on something, and you budget in your head, I'm going to take $200 there, and if I lose it, I lose it. If that's your view and you want to put $200 into Tesla, that's fine. It's fun, and just do it. But if you are truly investing, and by the way, that first thing I just mentioned, that category is really called speculation. So if you're speculating, just having fun, that's fine. You don't need to do a lot of research, right? But if you are, that I don't recommend that. But if someone wants to do it for entertainment, that's fine. Um, but the other category is investing. And investing is the idea is that you're very thoughtful about what you're doing, and so you need to understand first. What I strongly recommend in my book and in my class is you first go out and do industry research, because you got to understand, is it a good industry? Because you can buy a great stock in a bad industry. We say sometimes we call it the good house in a bad neighborhood. Well, you don't want to live in the best house in a bad neighborhood because you want to live in a bad neighborhood, right? So it's the same thing with the stock. Understand the industry first, and then understand the company and doing some basic things like knowing what they do. Once you know that, doing some things like reading their annual report, there are some of their other regulatory filings, their press releases, listening to one of their conference calls, which they, for the most part, will always post on their investor relations section of their website, uh, can really help as well. So you know what you're getting into, you know what the risks that are out there. Another thing that DePaul has that's awesome, and so few students know about it, is we have access to sell-side equity research reports, which through the library, which cost, if we weren't DePaul students, it would cost millions of dollars a year to get access to all this. Since you're DePaul students, you go into the library and you search under the, all the resources for Thompson One, and you got to run it on a PC running Internet Explorer. It's convoluted. You can email me if someone needs help with it. But the point is that once you get in there, it's got research reports from the top Wall Street firms, top Wall Street analysts about pretty much every company out there. So if you think you do want to buy Tesla, you can read from some of the smartest minds on why they would say either buy it or sell it.
Oh my God, I had no idea about that. And I'm a finance student, so I had no idea. I know that
Well,
we have
you have
access
to
to
take
Bloomberg.
Finance 336, equity research, because I cover all this in that class.
I got one more elective, so I mean, I may have to.
There you go.
Um, no, but I had no idea. I knew we had access to Bloomberg terminals. We can get some financial research from there, but I had no idea about all that. That is so cool. So I think that we kind of covered the basics of stocks. Let's move on to the next one. We kind of already talked about what should someone who doesn't know much about stocks invest in. So I think we can skip that question. Going on to what is an IRA? What is the difference between a Roth IRA and the S&P 500 index?
Okay, so that the second part of the question is like saying, what's the difference between a car and a dog? So we'll get to that in a minute though, because they're completely different categories. But the
Yeah.
first one is an IRA, is an individual retirement account. Now, I am not a financial planner, and this is really more for a financial planner question. I know enough to be dangerous here, so I'm just going to share a few thoughts because I do have an IRA. So when you go work for, if you work ultimately in a company that's got more than, let's say, 20 employees, they very often will offer some kind of retirement package where you, or say a retirement program where you can invest for retirement. And typically, so if it's in a company, it'll be a 401k. That's the part of the tax law. That's why it's called a 401k. If it's a nonprofit like DePaul, we have as an employee here, they have a 403, I think it's 403b. So it's just, that's what you do. And the reason why you have to do it through an employer is typically is that your employer administers it and they'll even match it. If you're not working for a company, or if you were working with a company, you have an IRA, I mean, you have a 401k and you leave, or you never worked for the company to begin with, you can start an IRA, an individual retirement account, and that can be a place to ultimately save money for retirement. You can't mix the two; they have to be separate. But the idea is that I'm just trying to think if I can say either one. Yeah, I could think for either one of them. The benefit is that you are typically saving tax-free. The nice thing is that it doesn't get taxed as it's growing over the years. So if you're actually investing for retirement, and let's say you ultimately have $20,000 a year you're investing, and you do that for 40 years, and it's worth, let's say just to throw out a number, it's $1 million. It's that whole growth that's happened in addition to your principal, the 20K a year you're putting into it, all the growth in it's happened tax-free. You don't actually have to pay any taxes on it. So that's a pretty good thing. And that's why I strongly encourage even my young daughter who's working at Target. I told her, join their 401k. Do it, do it, do it. She still says she doesn't want to do it, but it's a great thing to start. And if you do, even if you left the company after 2-3 years, you can then convert it into an IRA and it still continues to grow tax-free. What
Yeah.
is the S&P 500 is, which is a completely different topic. It's the 500 largest stocks in the United States. The Standard & Poor's company started this index decades ago, and they rebalance it every, I think it's quarterly. And basically, if you want to go and try to get an understanding of what's going on with the broader U.S. stock market, the bigger companies in America, you look at what's going on in the S&P 500. You'll hear this on CNBC and Bloomberg and in the financial media. They'll say the S&P 500 was up 2% today or down 1% today. That just means the broad basket of the big stocks in the United States as a whole were either up or down. Does that answer your question?
Yeah. In
Yeah.
terms of the index though, like when people say like I'm going to invest like $2,500 into the S&P 500 index, why? Like, what's the difference on the yield between an IRA and the S&P 500 index? Because the IRA is like a little bit of like, correct me if I'm wrong, but it is like a little bit of kind of like a mutual fund where they maximize the index for
Yeah, not really. So an IRA is more the instrument of, it's almost like saying I have a bank account, or I have a savings account, I've got a checking account. You would say I have an IRA account. Within the account, that's where you can trade. You can either buy stocks or bonds or ETFs, exchange traded funds, which we haven't really talked about. And that's probably, from my perspective, that's probably the best thing for students to think about buying. And that is, and it answers part of your question about the S&P 500. So you can't actually buy the S&P 500 in the sense that it's an index that's created by by Standard & Poor's company, and it shows you what stocks are out there that are in their index. You can go and buy those stocks that are in the S&P 500. And one of the ways you can do it, you can either buy all 500 stocks, which would cost probably, tens of thousands of dollars, or you can go and buy an exchange traded fund that mimics and follows along and tries to match what's going on in the S&P 500. You could buy that, and an ETF, exchange traded fund, is just a small unit. So you can buy an ETF, like you could buy an S&P 500 ETF for, let's say, $20. That $20 will give you a small, little, tiny piece of all the stocks that are in the S&P 500. That's in effect what you're getting, and you can either buy it just outright in a brokerage account like Robinhood. You can just go open. In fact, you open like a number of these discount brokerage firms are free, right? You can just go open the free. You can buy a $20 ETF, or you could actually put it into your IRA, or you could put it into 401k, that same ETF that's got a small fraction of all the stocks in the S&P 500.
So that's how people expand and grow their IRAs, is through these like little investment classes.
Yeah,
And
exactly. You could, in your IRA, you could go out and buy Boeing, a great Chicago company, McDonald's, another great Chicago company. You could buy stock in those companies for $1,000, $10,000, $50,000, or you could say, because I want to try to be diversified, like we talked about earlier, I'm going to buy an ETF that has all 500 of the S&P 500 stocks in it. Or you could get very specialized. You could say, I'm going to buy a financial services ETF that has all the financial services company in the S&P 1500, which are pretty much most of the larger financial service companies in the United States. There are literally thousands and thousands of ETFs. So one of the things you want to do, in addition to learning about kind of the fundamentals of a company, and kind of what is an IRA versus a Roth versus a 401k, another helpful thing is to understand all the ETFs that are out there. So you can search for ETF Finder, and there's a number of certain companies out there that have them. And when you find the ETF Finder website, it'll show you all the different ways. There's literally thousands of ETFs. You could say, I want a ETF that gives me exposure to French technology companies. There's probably one out there. And so you can slice and dice it. You could say, I want an ETF that gives me exposure to Japanese bonds. And the nice thing about it is they trade like stocks. You can buy them and sell them any time of the day you want when the market's open, and you get a little tiny piece of whatever it is that you're ultimately buying.
for the average student, could you just break down when we talked about ETFs a lot? Could you just break down what an ETF is to the very like simple, like at the simplest level you can?
Yeah, sure. So there's a number of companies that ultimately issues ETF. There's lots out there, but there's 3 or 4 that are really big ones. And you'll see when you start doing the ETF Finder, a lot of these, like iShares is one. I think they're owned by BlackRock. Another one is Spiders, which I forgot who owns them, but there's another owned by big, and the Spider stands for SPDR, and it's once again it's for the ETFs. And what these companies do is they go out, and this is getting a little bit past my expertise, but I believe what they're doing is, like, for example, let's say it's the iShares. Probably, I think it's probably the most established company out there that does this. And if they say, we're going to offer an ETF of transportation stocks, they will go out and actually buy, let's say, the 30 transportation stocks that are companies that are in the ETF. And let's say they buy $1 million worth of each one of these. So they've got 20 million, I say 20 stocks or 30 stocks, whatever. Let's say it's 30 stocks. They'll have $30 million of this stock. Then they'll go and create these ETFs, these instruments that'll trade on a stock market exchange that you can ultimately go and buy and know with confidence that the actual underlying share is held by the iShares people, but they've kind of sliced it in such a way where you're only having to pay for a little tiny piece because you don't have $30 million to go out and buy $1 million of each one, right? You may only want to invest $100, $1,000, $5,000 in transportation stocks. And so you get this little piece of the action. Does that make sense?
But yeah, no, it does. It's like a bundle of stocks, and it's
Yeah,
much
right,
more
exactly. So ETF,
affordable.
right.
Yeah.
Exactly. ETF, there'd be no point in having an ETF of just one stock because you just go buy the stock. So what they typically have, most ETFs will have at least 10 securities in them, and sometimes they can have thousands of securities in them.
Yeah. So, and just for the audience record, securities are debt or equity instruments that are bought. So like a stock or
Or a stock or a bond, or it could be like a real estate investment trust. But yeah, things that you can go out and buy. But typically, a lot of these things that you can buy are expensive to buy one unit. You know, to buy a bond, typically you got to start at $1,000. You want to diversify and own 10 bonds. Well, there's you got $10,000, a lot of money, right? So instead, you go and buy, let's say, an ETF that has in it all utility bonds, and they may own 50 different utility bonds in it. You have to pay $10 for this ETF because you're getting a little tiny piece of all those bonds.
okay. Okay, that totally makes sense. So kind of circling back to again, once like that question of if you're a student and you don't have this financial background and you don't really understand ETFs and they can be confusing, or if you still are like kind of feeling scared but you want to invest, what how do you tell them to go about that with like this IRA, like with the products that we just discussed?
Yeah, so I think it probably, because I can hear where you're coming from, and I get this question a lot. But given that we kind of keep going back to this point, I would probably say that the reason why I guess I'm maybe struggling a little bit to give you an answer is that if you're going to speculate and have fun with it, man, and do that all day long with some play money, go ahead and do it. If you're going to invest and you really want to be serious and you want to be able to understand all this stuff, it's going to take time. It's kind of like saying, hey, if we've got students out there that ultimately want to be able to ski Black Diamond Mountains, which are the most difficult ski hills out there, how do they do this? How do they get started? Well, you get started by skiing, learning how to ski on these small, like bunny hills. Then you learn how to do the green slope. Then you learn to do the blue slopes, and then you learn to do the Black Diamond slopes. And it's the same thing with stocks. The first thing is to go to Investopedia, sign up for their newsletters, the term of the day, that kind of stuff. Join a simulation, maybe one of the games. Pick a few stocks just for fun because there's no cost to it, and maybe open a brokerage account, one of these, like a Robinhood or any one of these discount broker, a Schwab account, TD Ameritrade, and if they're assuming there's no fee, and maybe buy one stock, just to, spend 20, 30, $40 just so you kind of get a feel for it, but then spend time deliberately every weekend or once a week or whatever to try to learn more about it, because it does take time to ultimately be able to feel comfortable that you are. There's no shortcuts. My point is that if you're going to be investing some real serious money and you really want to get to know this, you need to learn more. But you can learn a lot, like literally a year's worth of learning in Investopedia, or take Finance 336.
So okay, so then can people who are scared or do not know how to invest still benefit from the financial markets? If yes, then
Yeah. So if you say I want to be in stocks, and so um, a 18, 19-year-old kid I know through a family member came to me recently with this question. He said, I want to buy stocks. And he'd actually saved up about $10,000 through all his part-time jobs. And
wow.
I went through everything I talked about before. I told him, don't put all of it in there. But what I did, and I'll tell everyone here as well, is that basically we sat down, we went to an ETF finder. I'm out of focus here. So we went to an ETF finder and we looked for ETFs that were covering a diversified group of stocks. So like an S&P 500 ETF, we got him. I think he put like $1,000 into that. We got him an international stock ETF that had stocks from around the world. He put $1,000 into that. We wanted to have him have bonds. Some bonds can be sometimes beneficial to have as well. So I think we bought an ETF that gave him about $1,000 worth of domestic bonds, another $1,000 worth of international bonds, and we did a few other things a little bit beyond that. But that's kind of where you start. Is you say to yourself, assuming that you want to be invested in the long term, you want to be diversified, and the best way to do that is with an ETF. And so then you look for ETFs that are going to be in the categories where you want to be. And if you think investing in the US makes sense, then buying a broad-based US stock ETF or a broad-based US bond ETF would make a lot of sense. I'm not sure. Is that helping out, Brett?
No, 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 that definitely does. And that kind of like also gives me some clarity on like what the S&P 500 index is. So instead of like just buying the S&P 500 index, you're buying ETFs that follow the index.
Exactly.
And
Exactly.
then the kind of yield we find is that's where you said that 7, 8, sometimes 10%.
Yeah. So you typically, over the long term, if you go back and look, from between now and back to the 1930s, the U.S. stock market tends to grow between kind of 5, 6, 7, 8% a year over the long term. But some years you're down 40%, some years you're up 30%, and you got to be willing to take the good with the bad. And that's why you don't want your life savings, everything that you need to get from week to week, month to month in the stock market, because one day it might be down 40%. And by the way, I should mention that the single biggest problem or challenge to say investing stocks is market timing. If anyone thinks that they can get in before right the day before the market goes up and they get out right before it goes down, good luck, because the best of the best of the best, everyone out there that has been trying to invest, some for an entire lifetime, have never figured this out because it is impossible to do. So that's why you're much better off just saying, I've got enough money saved for my emergency fund. I'm going to put this money in the stock market for the next 1, 2, 3, 4, 5 years, and that we don't need to worry about, a certain ups and downs on a given day.
And a lot of people like when we're talking about long term, like I mean, obviously over a year is considered long term in our industry. But when we're thinking really, really long term, a lot of these students could put these ETFs for 40 years, I mean, 45
Absolutely.
years.
That's why even if a student's at doing like a part-time job like my daughter at Target, if you have an opportunity to do a 401k and you can put some money into it, put as much as you possibly can. You may say, oh, but wait, well, I could go and go out with my friends and do other things. Well, you want to have some spending money, right? But anything you're not going to probably need, put into it. Well, I should put a big caveat there. If you're going to be paying for college with it a year or two later, paying off your loans and so forth, once again, to be really careful because the stock market can be volatile. But if you get some money that you're pretty confident you don't need to be spending anytime in the near future, get invested in these 401k programs, because when you're 40 or 50 years old and you look and you say, wow, I've got $1 million saved in my 401k for retirement, you're going to feel really good about that. Or because of the benefit of compounding, the fact that you get interest on interest over time, it can really like snowball into a huge amount. The sooner you start to invest for your retirement, the better.
Yeah, and I mean, also you get those great tax benefits for the kids. So, no, it's definitely an incentive to get you to invest. I mean, that's the whole point of them, right? But I guess where this is going now is, how do we communicate? How do you do this in your financial literacy class? How do we communicate to students that, getting these 401ks, getting, starting to invest into ETFs and starting to, put some money into bonds even? How do you get students to do this so that they can be more prepared for their like financial future?
Yeah, so I think first starts with just motivation. Someone has to be motivated to do it, just like anything else in life. We may say like, how do we get people to eat better? Well, it's to be motivated to want to eat better, right? And to exercise more. So if there's no motivation or real interest, it's not going to happen. So I think we have to first say, for that audience of students who, and I'm not saying there's anything wrong with someone who has no interest in learning this, but the reality is there is, right? So first we got to find people who are motivated to do this. If you are motivated to do this, once again, first and foremost, I was kind of shameless plug. We have this financial literacy course that we offer at DePaul, Finance 205, that strongly encourage students to take. But there are all kinds of financial literacy programs out there. You can Google them. You also, even Investopedia can be helpful. One of the first things I strongly recommend a student does is download the Mint app, MINT. This is a company that started Quicken and ultimately became QuickBooks uh, 30 years ago. They were into financial online software before online was a thing. And so it's a highly respectable, great company. And they have a great app called Mint. And when you load it, after you load it, you want to go and put your bank account and your credit card accounts connected to it. And you may go, wait, hold on, Valentine. One important thing to understand with this service, and a lot of these services like this, your bank and your credit card company have two types of feeds that can get accessed via the internet. One is you can get in and actually do transactions, but two, there's a read-only version that they make available to things like Mint. So even though you're giving Mint your information about your bank account and so forth and your credit card company, all it can do is draw information, numbers out of your account, meaning the information. It can't actually take money out of your account or charge things. So just be aware that that's a safeguard. But what it does, it gives you, it tracks your budget. It shows you how many times you went to Starbucks last week and what you spent the last month on coffee houses, and shows you what you spent last month on restaurants and so forth. It's a great, great app. I always encourage students to start it sooner than later, because one of the basic steps of financial literacy is to know how much money you spend and how much money you earn. And then from there, you can start to build budgets. You can start to think about savings, think about investing, but getting your hands around your spending is really important. That's a great app. That's an important thing to understand about financial literacy, having taught a class on it, is that the best financial literacy program is the one that you find that works. And if you find an app that you're like, this is just a killer app and it helps me keep track of this, there's one of the things we teach in the financial literacy course is called envelope budgeting. And the idea that for some people, when you come home, you keep all the receipts you get throughout the day. At the end of the day, you put them in envelopes that have labels on what they are. This is my fun spending money. This is my coffee money. This is my grocery money. And so my point is that yeah, it's awesome that you have a method, and I encourage people to explore, ask their friends, find as many methods as you can, but just find the one that works for you.
Yeah, no, no, I agree. And that the whole point of that was like, it's very personal. So like people have to like find what works for them. I mean, yeah, 100%.
Exactly.
So I guess for our final question, and we've kind of really hit the nail on the head with this, is what are some helpful tips or resources you would offer to the DePaul students who are interested in investing? We've kind of already heard, a lot of the big names like Investopedia. We heard that a lot, simulations. You even mentioned, what's it called? Thompson one, right?
Thompson one, yeah.
Yep.
So
And
go ahead. And you have we have Bloomberg in the library. So the library has, I think, 4 Bloomberg terminals. You can go through the library portal and get access to those. It takes a little bit of work. You got to get registered right now while we're doing the remote campus. One thing I didn't mention that might be helpful is that CNBC, if you want to kind of get a little bit hardcore and kind of nerdy into the stock market, understanding kind of what's really going on. And I know students, like actually probably like professionals, don't have all day to watch CNBC. So what I encourage students to do is watch the first 15 minutes of either of the morning shows. So the first morning show comes on is um, I won't say Squawk Box, but actually I think it's the second one. There's 2 Squawks. They have them different names, but one comes on in Chicago time at 5 a.m. and the other one comes on, I think, in Chicago, I think at 9 a.m. They're back to back. They're the first 2 programs in the morning, and I encourage you to watch the first 15 minutes of either one of those, whichever you're more comfortable with, because they usually have a recap of kind of what happened last night, what happens this morning, and it's just really good. They tend to be a little more in depth and they think about the fundamentals. Whereas the other thing I like encourage students to watch is Fast Money, which is at the end of the day, and I think that comes on at 4 o'clock Chicago time, and that is a very different. And by the way, you don't need to watch the whole thing. Watch the first 15, just like in the morning shows. Watch the first 15 minutes 3 times a week. The Fast Money, watch the first 15 minutes 3 times a week, and that's more of a trader show. It's more of this kind of, I talked about speculators trying, do I get in today, do I get in tomorrow, what's the sentiment about a stock. It's a very different way of thinking about the stock market, but it's nice if you listen to both during the day, because then I assign these to my students, and they'll come back and tell me the same thing. They're like, wow, it's very different. And that's good, because then you have to realize there's different perspectives on how to look at stocks. I would say most of all the things you've talked about here are, in addition to the CNBC resource, Wall Street Journal, WSJ.com. I think it's $1 a week for student subscriptions. I think
WSJ
it's
is
great
big.
just to read the front page every day, even for 5 minutes. Just gives you a general idea of what's going on. Those are all, I think, some good resources.
Yeah, no, I 100% agree. And I think that's a big part of investing is like you have to learn that you have to read to do it. If you don't read, then you can't stay above the market. It's just, there's no way. Like, I mean, you can't hear it from word of mouth. Like, it's not, everything travels so fast. Students shouldn't be scared of investing into the market or putting money into a 401k, because we have lots of different types of accounts that help people prepare for retirement and, you know, help you feel less stressed about going into it. And it doesn't have to be this big scary thing of saving.
If there's concerns or anxiety by a student about investing, I'd say first, make sure you've paid off your high cost debt, and make sure you've got an emergency savings before you do any considering, because you don't want to, you will become more anxious if you don't have those things and the stock market blows up. But if you got those things behind you, if you invest slowly, kind of slowly dip your feet into the pool, get at the start at the shallow end, and then get a little bit deeper and deeper, a little bit more money over time, every month, every 3 months, however often. I think you'll get more and more comfortable with it. Like so many things, it could be like riding a bike. It's very uneasy right when you get the first time, and then as you get older, you might be ready to ride a motorcycle, right? And it's that kind of building that confidence and understanding the ups and downs and the terminology. I think the reality, I mean, and I know the reality is, though, it's been shown that over the long term, among the major classes of things you can invest in, stocks will get you the best return. So if you've got no high cost debt and you want to be able to generate some decent returns over the long term, you would be shortchanging yourself if you didn't think about investing in stocks. And that's why I think the sooner that you're able to start to just even dabble, even just a simulation, the better you'll be, because at least you're educated on this great class of assets that tends to grow the fastest over the long term.
Yeah, that definitely gives the most yield. Professor Valentine, thank you so much for coming and doing this. On
My
the
pleasure.
behalf of the DePaul community, you are a great, great, great resource here. And
My
it's
pleasure.
but I think that's it. I think that
Okay.
we can call it a
Okay.
wrap.
Good.
All right. Hi, everyone. Welcome back to Make It Make Sense. We just got off of a great interview with Professor James Valentine. And now I am here with my colleague, Lexi Reed. Lexi, did you kind of want to introduce yourself?
Yeah, for sure. So my name is Lexi Reed, just like Brett said. I am the Senior Peer Financial Advisor for Financial Fitness. Been working here for a while. I am studying applied and computational mathematics at DePaul. I love math more than anything, but I also like financial fitness, and Brett's all right too.
Thanks. I appreciate it. So Lexi got to listen to the podcast that James and I recorded earlier. So Lexi, I just kind of wanted to get your kind of input on ETFs. Now, for those of you who don't understand, an ETF is an exchange traded fund. James describes it as a bundle of securities that help you stay diversified and whatnot. I actually didn't even know I was investing into ETFs. Little shout out, I have spider ETFs. That's why I was asking about the S&P 500 index and saying I am investing into the S&P 500 index. Those are ETFs that actually follow the index. So some clarity for those of you guys who were a little confused by that, and my apologies. But anyway, Lexi.
All right, so yeah, just like what James Valentine said, I would also describe ETFs as a bundle of stocks. I really like that definition and how quick and I feel like kind of easy it is to understand what it is. ETFs are really nice. We're going to talk about it a little later, but for making sure that your portfolio is really nice and diverse because it already is a bundle and you don't need to individually pick out these stocks, which can be kind of a pain and a little more time consuming, especially if you're a student trying to invest. So ETFs are a great option. And definitely recommend it. I mean, you did it, Brett, and it seems like it's going pretty well. You want to speak on that at all?
Yeah, I mean, when I was 18, I got a small sum of cash and I put just a little bit of it away. James even kind of talks about how you should, if you're going to have to need that money, then you should not, invest it. You should be paying off your debts first. I think I'm doing pretty well. Honestly, I haven't checked it in like a few years. I get like the yearly thing for my taxes, but that's really it. So I think it's doing pretty well. I mean, like it's definitely made some money.
All right, so also in the podcast, James Valentine mentioned that DePaul students have access to like investing practice. It's called Thompson One. So if you ever want to do that, if you're kind of like, I want to get started with investing, I don't know how, or maybe I don't even want to invest my own money, I just kind of want to see how the stock market works, you can definitely use this simulation and try it out for yourself. Try and see how it makes you feel. Look at some ETFs with like the low stress of not really investing your own money. I did something kind of similar to investing, like an investing simulation in high school. I took a business class, but I was in high school. I didn't know anything about stocks. No one explained anything to me. So I just invested in like the stocks that looked familiar, like Nike and Disney and Apple, and that's it. I was like, those look good. People say they're good businesses, but I know a lot more about stocks now, so I think it'd be really useful. Have you ever tried any investing simulation or something like that, Brad?
I actually had no idea that these things existed until I did the recording with James. I wish I would have known sooner. Now I kind of want to try them out. I mean, he did kind of touch on that Thompson One is a very, very expensive resource for DePaul, and it kind of makes me feel like, well, if I'm not using it, am I even getting the most tuition here? But no, the answer is no, I have not. But I will be trying one soon. What about you, Lexi? I know that you kind of said that you had one in high school, but have you tried like a professional one like Thompson?
I've not tried a professional one. I've also not tried since high school. I know a lot more about stocks now and how to invest in the market, lucky for me. But I was just kind of okay with jumping right into it, kind of taking my time with investing, starting up slow, just investing like $20 or something. Because once I started this job, I immediately had to start learning about stocks and I just felt a lot more comfortable jumping right into it. But at least having some experience though with that simulation in high school, even though like my portfolio did terribly. It was nice just to kind of see what it looks like, how it feels to invest before really getting started. So I'd still recommend it.
Yeah, it definitely helps to like kind of reduce some of the anxiety surrounded by investing, because investing can be a very scary thing. I mean, you can lose a lot of cash, and sometimes that's not the best feeling in the world, but you can also make a lot of cash. So this is a great way to really get people to get started and kind of get like a practice round, no risk, no gain either, but no risk from just practicing.
Yeah, exactly. And then just kind of moving on from risk and kind of that conversation, it is important to think about risk, when we're investing and kind of how that'll play out in the future. And especially when we're young right now, we have all the time to invest. We're not close to retirement age at all. So now is really the time to be risky. I don't really think I understood that, or like really what risk meant in terms of stocks. Like I was just like, oh, like this stock has like it's up a couple of dollars or something like that, must mean it's good. But I'm like, am I being risky enough? Like, am I investing in enough stocks and things like that? I mean, I wasn't investing in bonds or anything, which is definitely less risky. But I didn't think about why it's important to be risky and like really push myself a little bit. So that's definitely something that I've been thinking about a little bit more since joining Financial Fitness and also rewatching the podcast.
Yeah, your risk profile when you're definitely in the younger years of your life are definitely more. We want to stay in that risky lane to make sure that we're maximizing our returns on our investments. You mentioned bonds. Bonds, for those of you who don't know, are very, very safe investments. They're definitely not risk-free. Well, some are. U.S. Treasury bonds are risk-free, but some are. There is no such thing as a risk-free investment except U.S. Treasuries. But yeah, so bonds are definitely something you want to look into when you're getting closer to that retirement age, whatever it may be for you, whether that be 60, 65, 70, whatever do you.
With being risky, and also thanks, Fred, for mentioning bonds. I did not explain that at all. You do get the most return when you do invest in the stock market. The stock market is the riskiest thing that you can invest in. And because it's so risky, you also get the highest return. Like Brett was saying, there's like a risk and return. So being aware of that, and also thinking about your investing in terms of how old you are, like Brett mentioned, are you close to retirement age, not close to retirement age? I think it's really important to think about.
Yeah, and like Lexi said, just as a simple equation, as simple as we can make it, more risk does equal a higher potential return. Now, that's the point of risk. We can never eliminate risk, but we can manage risk through diversifying, which is our next topic we wanted to kind of touch on a little bit. We briefly talk about diversifying in the podcast with James, but to kind of give you guys a simpler idea of what diversifying really is, it's just not putting your eggs in one basket. And this could be in a multitude of ways. We don't really get into it too much on the podcast, but diversifying is a way to manage risk. Think of it as something that we can do when we are, buying stocks, bonds, commodities, real estate trusts, whatever it may be. There's several asset classes, and diversifying into several different asset classes helps us to maintain a diverse portfolio. So going back to Lexi's example from high school, only investing into fashion companies would not be a good portfolio, right? So Lexi only invested into Nike, Adidas, and what else is like a public one? Help me out here, Lexi.
Oh, I don't know. Like Disney or something. It doesn't matter.
Regardless, investing only into fashion companies may not be a great idea because, if the fashion industry fails tomorrow, then you can lose all your money. It's better to invest into multiple industries. And that's something James kind of touches on as well, is, understanding the research behind these industries. But Lexi, give us your perception of diversifying before we get into industry research.
Yeah, for sure. So totally agree with everything that you just said, Brett. When you were interviewing Professor Valentine, he mentioned an example about like tech companies. So not fashion companies like me. Like say you are investing in just like Apple and Microsoft, because they're like the big, and maybe Google too. And I don't know, if something
Google.
really goes down with tech, exactly, everyone loves Google. But now your entire stock portfolio, all this money that you've been investing also goes down. If you have some other stocks in your portfolio that isn't also going down with the tech industry, like diversifying, like we've been mentioned, it just isn't going to hurt as bad.
Yeah, no. Okay, so now that we hit diversifying, do you want to talk a little bit about like industry research?
Yeah, for sure. So industry research is something that's really useful, and I think would be really nice to pair with if you were thinking about using something like Thompson one, like we've already mentioned, in practice investing. Because while you're practicing, you need to be like reading about the industry, because like I said, maybe something's going on in the tech world, maybe something's going on in the fashion world, and that is going to affect how the stocks are going to be going up and down. So you kind of need to be up to date on what is going on. So making sure that you're reading resources like Investopedia or other websites that you might find that have a lot of information
Wall
on
Street
stocks.
Journal.
Exactly.
Yeah, the big ones. No,
Yeah.
I definitely agree. Lexi is 100% right on that. If you really want to be on top of your investing game, then the first thing you really got to do is start reading all of the newspapers and all of the investing sites and getting financial research as much as you can, reading as much of it as you can to maximize the return on your portfolio and be the best investor you can be. Now, this does take quite a bit of work and motivation, and we understand that not every student may want to get super into stocks and everything, but there is this sense of once you get started, it's not so hard, right? Like when we first start investing, you can feel a little uncomfortable. But like Lexi kind of said already, using those simulations as practice can kind of help reduce the anxiety surrounded by investing. What I'm trying to say though is it's good for people to engage, because the sooner you start investing, regardless of the risk factor, regardless of the asset class, the better future you potentially can have.
Yeah, exactly. And just also to add in something real quick, is yes, it's important to be up to date on stocks and reading everything, but to be a successful investor, to get a large return, you also don't need to be an investor who's constantly buying, constantly selling, always trying to, get the best, because that is very challenging. The stock market changes
Exactly.
all the time. It is very, very challenging. So when we're talking about reading about the stocks, doing some research into this, we're not saying buy and sell all the time based on the market, do all the reading, because that's hard. It's very hard. Like I said, it's
Some
totally
people do that as
okay.
their full-time job.
Exactly.
So
it takes a long time to learn, and I don't have the
that.
time. Right. Yeah, so definitely feel free to hang on to them, but hang on to stocks, to clarify, but making sure that you have a diversified portfolio. You should still be able to get like the 7 to 8% return that we see with the stock market, like every year.
Over like the long term. And that is another thing I really wanted to quickly add on. And James kind of touches on this as well. The stocks, yes, they are the riskiest security to invest in, but they are the ones that generate the most return over the long term, right? Over the long haul. So over 30, 40 years, we can estimate a pretty good return, but that's not guaranteed. Some years, like he said, are really bad years. Sometimes the market's down 40% some years. Some years the market's up 50% or 30%. So like, and these are big economic factors that factor into the S&P 500 or whatever stock index you want to use. But the big deal here is that yes, even though stocks are risky, they do generate the best return over the long haul. We can back that up with statistics and analytics and what have you. But that's just something we really want to kind of emphasize to the younger crowd here at DePaul, because it is important to know that.
So we've been talking about investing. I mean, even James Valentine was talking about investing and like how to get started. Where does this money come from? It's important before you get started investing that you kind of have all of your ducks in a row, if you will, making sure that if you have really high credit card debt that you kind of want to take care of, feel free to pay that off. You don't have to pay off all of your debt in order to start investing. That's a personal question that you should ask for yourself. But if there are some things that you're like, hey, I kind of want to do this and then I'll start investing, feel free, or decrease the amount that you're investing depending on your goals. And that's kind of where like financial literacy comes in too, also with investing, because when you're investing, you shouldn't be using money that would be for like groceries or rent or something like that. Like spend that money on what it should be for. You should be investing money that is in savings. How do you have savings? You already got to be saving somehow. So making sure that you have some savings, that whatever money you do invest in the stock market, it's money that you're okay with not touching, maybe losing, because like Brett said, it could be down 40% or whatever one year and up really high the next. So just making sure you kind of have a solid base before you get started.
100%. Like, and we talk about this idea of like a rainy day fund, and Professor Valentine says that it's supposed to be about 3 months of just cash that you can just quickly take out and, use that can support you for up to 3 months, your normal spending. So like, and he also mentions paying down your high interest, credit card debt or, student loans he mentions are kind of shaky, but, you know, he mentions that like you should have all these things like Lexi said, your ducks in a row before you really start diving into investing. And I mean, that's just something we want you guys to consider. We don't want you guys to like feel pressured to immediately start investing. Not that we're pressuring anyone to start investing, but we do want you guys to do this in the most safe and how do you say that? Most safe in what climate? I don't know.
Yeah, I'm not sure.
The
but I know
best
what
way
you're trying to say.
possible.
Yeah.
Yeah, we want you guys to start investing the best way possible. And that typically is, making sure that all of your other finances are handled before you start risking some of your financial earnings, which is just cash. So, we just want you guys to think about these things. I think that's all we really have to hit today. I hope that you guys like the podcast. I hope that you guys learned something new. And if you guys want to make an appointment with me or Lexi, send us an email at financialfitness@depaul.edu and we will get you guys set up. And we do more appointments than just investing. We do student loan management. We do a lot of things, guys. I mean, if you're in credit card debt, please, we can help you. This is what we're trained to do. So Lexi, is there anything else you kind of want to plug before we go?
Nothing else to plug. Feel free to make an appointment with me or Brett before I graduate, like I mentioned earlier. And I also just want to add real quick too, investing is scary, but it's really important to get started as early as possible because that is when you also get the most return. So when you feel ready, when you have all your ducks in a row, feel free to make an appointment with us to get started or use some of those resources that we were mentioning like Thompson One or Investopedia to read on your own.
Yep, I 100% agree. Well, guys, it was great. Have a great day.